Hello and welcome to Ono Academic College Executive Summary. My name is Raouf Acampora, and I want to thank the college for hosting the Israeli Chamber of Technical Analysts. We had a fine seminar, and I would like to summarize the key points of my presentation. To begin, technical analysis is a subject not unto itself, but we like to host it, put it together, fuse it, if you will, with fundamental analysis. And behind me is a circle with the letters IBM. And an old gentleman told me many, many years ago that there are two parts to every situation. In the case of IBM, you'll see the top of the circle is the company. And when analysts look at the company, they're talking about price-earnings ratios. They're talking about the company's dividend. They're talking about the management of the company. They're talking about competition. When you put all these factors together, that's what fundamental analysis is all about. They're talking about the company. My message today is not just the company. We're going to zero in on part two of that circle, and it's called the stock. To get the whole picture, you not only look at the company, but you zero in on the key aspects of the stock. When I think of the stock, I think of price, and I'm sure we're all concerned about the price of our stock. We call that momentum. When the stock moves up in price over time, it's said to have strong upside momentum. When a stock levels out, it's said to be neutral. And there are periods of time, of course, when stock prices will recede, move down, downward bias, be vulnerable, whatever the case may be. Part two to the stock is volume analysis. We affectionately call that flow of funds. When you have your stock moving up in price, you want to see that supported by more money, more demand, supporting the movement of that stock price. We call that momentum. That momentum, that flow of funds, is what gives the stock the sustainability, if you will, on the upside. Part three to the stock is time. How much time are we dedicating to the movement of price? There's a big debate on Wall Street these days as to defining what long-term means. Long-term used to be measured in decades, but I think with the volatility of the market over the last 10, 11 years, we're talking more long-term is more measured in maybe a couple of months to a couple of years. And that's important, as opposed to being a very short-term trader. So we're talking about flow of funds, we're talking about price over a period of time. So if you're a long-term investor, you're by definition saying you want to hold the stock for at least a year or more. And the last part of this is psychology. How do people feel about their stock? Are the insiders, that's the CEO and the CFO of the company, are they buying or selling their own company stock for their own account? That, I think, would be very, very interesting and very, very important to see if management really believes in their own company. I present this to you, again, under the guise, under the auspices of fusion analysis. By looking at the company and now studying the stock, we have a total picture, I think the full picture, if you will, in this case, IBM. That was my first message at our meeting. The second message is a little longer term. It has nothing to do with the individual stock per se, but it has to do with strategy and how one looks at strategy. Some of us call it a top-down approach, and you can see from my hands, I'm using the outline of a triangle, if you will. It's almost like a pyramid. On the top of that pyramid, the top of that triangle, is the index, the market index that you want to zero in on. Let's say, for instance, the Dow Jones Industrial Average. If that's your index, then you look and you study that index. You look at the major trends, you look at the minor trends of that index. You try to assess how strong that particular index is. Of course, realizing in this particular case that Dow Jones Industrial Average is a blue chip indicator. It's not measuring small stocks, not measuring mid-cap stocks. It's talking about large cap. But again, if that's your decision, then that's where you start. Second thing you do, top-down approach, is that you look at how the breadth of the market's doing. If you were to ask a technician, how is the market? Most technicians would say, well, it's not a stock market, it's really a market of stocks. And by that they mean individual stocks. The majority of stocks are really what count. We know how important the Dow Jones is in the eyes of many, many people, but when you look at the breadth of the market, for example, I'd say roughly about 3,000 stocks trade every day on the New York Stock Exchange. Wouldn't it be interesting to find out if, let's say, the majority of stocks, let's say 2,100 or 2,200 stocks were on the upside versus 1,800 on the downside, or 1,000 on the downside? Maybe you have 2 to 1 positive market breadth. That's very, very important. So let's assume that Dow is moving up and breadth is supporting the move by having more and more stocks participate. I like that picture. Phrase 3 would be, we start to look at the psychology of the marketplace. Are the investors bullish or bearish? And there are many, many ways that we can measure that. There's an index called the bull-bear indicator in the United States where they actually take a host of market letter writers. And I think about 150 different market letters. And they calculate each week how many are positive, how many are negative. And interestingly enough, at major market peaks, guess what? Most market letter writers are too optimistic. So you be a contrarian, go the opposite way. And that works conversely on the downside. When most of them are negative, it's probably a time to buy. So we did the index, we did the breadth, now we just measured sentiment or psychology. Next thing you want to look at, doing the macro top down, you want to look at psychology, you want to look at sector analysis. Now that's all of the S&P 10 industry sectors. It starts with consumer discretionary, ends with utilities. So you'll find the sector that you like. Maybe it's gold materials, gold mining stocks. The next step you do is you go into intermarket analysis. Again, top down. Intermarket analysis, talking about the metals that support your sector analysis. So if you like gold and you like the gold metal stocks, they confirm the picture for you. And then beyond that, you start looking at exchange-traded funds. You can buy the GOLD, which is an ETF of gold. It has physical gold in its ETF. It's very interesting. And lastly, you go right down and you look at the individual stocks that make up the ETF. So that's top down. Bottom up, you do just the opposite. You start with an individual company, and then you start to see how it fits into those segments that we just talked about, how it fits into the sectors, how it fits in with the commodity picture, how it fits in with sentiment, and lastly, how it fits in with the market average. So top down, bottom up, the full circle that we had, fusion analysis, those were the messages that I presented today. Thank you very, very much.